We just explained a covered call, now a cash secured put.
So the difference on the a covered call means you own 100 shares, which could be taken from you, called from you, if you allow it. If you let that go through and it's 1 penny over $110, just 1 penny, they'll assign you. Okay. But you don't have to let them do that. You're watching that. Boy, if it gets close and you're at 350 in the average, if it's right on the money, even at 350 is pretty good because you've let that do what's called time decay. When the contract value, there is this
Stated time decay.
where the price is of the value of the contract, and we'll get into that. By Friday, 4 p.m., it will be close to zero, 0.001 cent per share. Okay. It never goes to zero, but it comes close. Yes.
So if it's starting to get near, like in this that you're showing here, if it's getting close to 110 and they're thinking it's going to 120, you can close out your own option
Mhm.
yourself.
Yep. Yep. Buy to close at any time. You're going to lose some of your premium to do that.
Did not know that.
Yes. When you see it, it'll be buy to close, sell to open, to close. And the one that you want to know the most is STO, sell to open. That's what we are. We're sellers of time with Mina Waits. Okay.
Now, the other contract,
Is what's called a cash secured put. Now, the difference is you don't own any shares. You can do this type of trading and never own a company ever. But you must have the cash. But in this case, it's trading at $100 on Monday, and you go, I would love to own Apple, but at a cheaper price. So I will put out $9,000. Okay. And your, whatever your platform is, will put that on hold in your account. You can't use it. It's sitting there on hold, $9,000. Now, in this case, if Apple goes up, it's going away from your strike of 90. Okay. When the stock market is climbing, it is good for your cash secured put because it's going away from it. So way, and the value of your contract drops to almost zero if it goes up high enough. And at any point in the week, you could just buy it to close it, and you get all your money immediately back available. Okay. So, what happens if Apple does go down and it comes down to 90, 89.99? What will happen? And that 90 minutes between 4 and 5:30 in Chicago at the clearing exchange, they will take your $9,000 and assign you 100 shares. What if it's at 80? Aha. What if it dropped to 80? Now I have to pay $9,000 to get $80 stock. Well, the guy that does that say, thank you. I just made $10 per share down here at 80 on your put. The shares are put to you, called away, put to you. Okay, right there. You say, well, I want my cash. I don't want to lose my cash. So the reverse happens here. Instead of letting them at 4 o'clock, letting that go through, what you then do is the same thing. You keep your 90
Strike.
and roll it a week. Put another week of extrinsic value in there. It's not going to pay you as much as if it's clean, original 100 or original cash. Why? Because you are buying the intrinsic value, which means you're not the one, it's not coming out of your pocket. You have to adjust your time to be able to overcome that intrinsic value if you want to do that. So that you have, in addition, it covers the intrinsic value plus a little bit more you put in your pocket. That might mean going to 2 weeks, maybe 3 weeks, maybe a month. Now you're tied up in a cash secured put, but you're gonna get an additional premium. I don't know what that's gonna be to roll it. The cost of the intrinsic value plus the time that you're adding to your contract. Once you own that contract, I am telling you, as a seller, you have all the, what's the word I'm looking for? It's very valuable to own a contract because you can adjust those contracts forever. You should never, if you don't want to, if you want to throw it out a year, no one's touching your contract for a year or 2 years. You're going to get premium, but you're going to get into why that is an issue. Okay, now, and here, one of my slides says like this: as long as the stock market is green, for both covered calls and cash secured puts, you will never lose your initial funds. Never. As long as the stock market's green, you will never lose what you have put in to that contract. Because up here, you are making $10 a share, right? If you so choose, you're at $10 a share. And if you let it go, you have made $1,000. Even though it's sitting up at 120. Green. Cash secured put. Green. It's going to expire worthless. Why? Because it's going away from your strike price. When the stock market is green, it is impossible for that time frame, if it stays green, goes green, for you ever to lose your initial capital or your premium. You may have what's called that value. You go, but to get this value, you have to sell your shares at 120 to get the realized gain. And when you are doing what we're talking about here, you don't have to sell it. You're going to let time buy that week or two. Up here, down here, if you have to, you're going to let time, and you could roll it down to 80 and let time pay the difference between your strike. If this is your strike, you can then set a strike for 80 and let time pay that difference. Does that make sense? And we're going to get into this a little bit more. Hey, good to see you here. We've kind of gone through a lot. But anyway, that's the basis of what I want to get going. How are we on time? Up there. Okay. Now, here's what we go. Oh yeah, I see that. Okay. So I'm kind of getting into how this works, seed money, and what the risk, rewards, and what you need to get started in your platform. So this terminology, M&A, means MENA. You're going to be using seed money, and that, again, that's coming from Matthew 25, in the form of a MENA option contract. And we like, again, we have to catch up the history to what we're doing. The first option trader in the history recorded by Aristotle way back, 500 years way before Christ. Anyway, so this is it's called seed money, money allocated to initiate a project. Number one, how to sell options, and here, establish benchmarks. So now this is a different situation. In real estate, what is one of the principal factors in determining the unrealized assessed value of any kind of properties? One of them, and I know you've heard this all your life. Location, location, location. That means some properties have higher value than others. Same with the stock market. There are some companies that basically they have a lot higher value. Okay. In selling options, what is one of the principal factors in determining the return on investment, ROA, and risk in using this type of financial instrument? Benchmark, benchmark, benchmark. So what are they that I want you to know? So this is probably very familiar to a lot of you, in that the financial instruments that give you a return on investment, starting with banks. So in your checking account, you have money in your checking account. What is the rate of return on the checking account? 0.01% per month. 0.01. What is it in the savings account? Not much better. How about the money market accounts? I have pictures on, what's that?
3 point something.
3 point something. Very good. And I've got a picture coming up here. 3 point something. Certificates of deposit. What do you think? So, as I was driving here today, I passed OZK, Bank OZK there in Blairsville, and on the screen it says CD, 4%, 7 month. Did I just, oh shoot. That's a sensitive thing. Okay. So 4% is what I am going to use as the benchmark percent rate for your return on investment in selling options at 1 year, 365 days. I'm going to use that to compare with what we are doing. And I'm going to figure it out on a day-to-day basis. That's real important. And if you look down there, you can get certificate, annuities, government fixed interest securities, T-bills. They mature less than 1 year. Treasury bonds, less than 10 years. Corporate bonds, fixed interest securities. In the stock market, you can buy stock, do ETFs, cryptocurrency, or options. As of last night, this is the money market value for Regions Bank. Okay? 2.96%. And that's all I have in my, all I've gotten so far year to date is $15.11 at 2.96. And you must have a minimum amount to get it. Usually around 10 grand. This is a money market at Bank OZK, and it's showing 3.65%. Here's a CD with United Community Bank that it was a 13-month CD that's still ongoing, and it brings out every quarter, every 3 months, it'll update. And so it updated this December 31st, and it's 3.9223%. And when it says accrued interest, that's all it's done for this month. Because anyway, it accrues it, but doesn't pay it for every quarter. So here's what I asked Siri. What is the standard 1 year CD interest rate? For example, if an investor puts $1,000 in a 1 year certificate of deposit that pays an annual interest rate of 4% quarterly, the CD will earn 1% interest per quarter on the account balance. Does that make sense? Everybody on board? We got everybody? Okay. So finding this benchmark is using what you're already comfortable with, but we must understand that when we do a CD, you're locking that money in for 12 months or 365 days, and you cannot take it out without penalty. Correct? Your money is locked. So I'm going to explain this. The benchmark can be found using my rule of 10. What that means is if you're selling, try to keep it within 10 days. Why? Because you get the highest premium per day, and we'll show examples of that. Versus a one-year bank CD, T-bills, or bank money market paying monthly interest. You should follow that, except Palantir's reporting in 2 weeks. And that makes the volatility go up and your premiums with it on Palantir. Just saying, and that is, you want to keep that in mind, is that you want to see that. If you look at the reporting on February 3rd or whenever it is, and you look at the option chain after that, you go, oh, wow, look at how high these premiums are. Why? Because they don't know what it's going to do, whether it's going to go skyrocket if the report is awesome, or it's going to tank if the market doesn't like it. So the volatility is so much higher right before the reporting. And so if you
Sell.
a contract that goes out past the reporting, those premiums are high. Anyway, so that is something you want to keep in mind. What are the best platforms? And we were talking about that earlier today. So the ones that are out there, some of them you're familiar with, Tasty Trade. I'm not familiar with it. I've heard of it. I use Charles Schwab. There's Interactive Brokers, Fidelity, and E-Trade, and we're going to talk about Fidelity. Fidelity actually, and this lady already knows, you get better return on any
Swept.
money through Fidelity than you do with Charles Schwab. Do you use Fidelity?
I'm using both, but Fidelity, you get interest on your money right after the time your option.
Yes, you get a much better interest than you do at Charles Schwab. I, by default, had to go on Charles Schwab because it was Scottrade, then TD Ameritrade, which then got taken over by Charles Schwab. And so that's where I'm at. But I like what I got on Charles Schwab. I know how to use it, and it seems to be workable. So here's something that you need to know. When you start doing options, you can't just go out there and say, okay, I'm going to get on Charles Schwab or Fidelity and I'm going to start doing it. They won't let you do it. You have to qualify. What does that mean? They want to make sure you're not going to get your behind taken down. Why? Because when they start seeing you, maybe this person's going to buy them. And any of you have ChatGPT? So maybe sure. Anyway, let me just tell you, if you click on ChatGPT or Grok, and I may have this question in there down line, if you put into the question, into the prompt, remember on that gray box, you're going to put the prompt in, and you're now asking ChatGPT a question, and you're developing a token. So what that says, what you're doing is you're saying, what is the consistent returns of a retail trader in buying options? Only 10% or less. What? That means there is a 90% failure rate when you buy them. Well, who's on the other end of that trade? You are. You're on the other end of a 90% plus failure rate because you're now 90% plus success rate. And if you do it right, you can make that almost 100%. I can't guarantee. I'm not, like I said, I went through that disclaimer. I'm not trying to tell you to buy or sell or anything. I'm just trying to give you some information on what's possible. What is possible? Okay. They're required by financial regulators like FINRA to assess an investor's knowledge and experience to determine the appropriate options trading level that they are approved for. But the good news is level 1 is covered calls. Well, you can sell covered calls at level 1 really quick. All right. So they're going to want to know how much years, how much you experience trades, your net worth, annual income, your objectives, risk tolerance. And then there it is. Basic strategies like covered calls or protective or cash secured puts are typically easier to get approval for, level 1 or 2. While more complex, higher risk strategies like uncovered, never do you do a naked anything. You will lose your behind. That is a no-no. Any uncovered, which requires higher approval levels, because you will lose big time. Never do any uncovered anything. Okay. Now, if you want to get experience, you can do paper trading. Paper trading on Charles Schwab is called Think or Swim. There's another one out there called Market Watch, but they have different ones like a Think or Swim. Apparently Webbull, E-Trade, Interactive Brokers, Tasty Trade, and Moomoo. I've never looked at Moomoo. I have no idea. They allow you to play trade, called paper trade. Okay? And then you can see how well you actually do in real time as you paper trade. These platforms allow you to learn the mechanics of options trading and test strategies using virtual currency in a risk-free environment, making them ideal for beginners who do not yet have the qualifications for a live account. And if you look at the bottom, you can see there's more than one source, and it keeps going and going and going. That's what your AI search will do. It will take one site and then another site and then put up, like I said, it's trying to put tokens out there, what it thinks it's supposed to say. You follow me on the tokens? I think that was good for people to understand that. So here's with Fidelity. How do you get started? Open or use a standard Fidelity brokerage account, no special options account needed. It's the regular one. Then you apply, okay? And you'll have to follow the chain of command here to get to your account, then margin and options, and complete the application. If approved at a basic level, you can start with covered calls. Once you own qualifying stock, that means you have to own 100 shares of something to be able to sell a covered call. Or at level 2, for them, cash secured put. That means you own the money to be able to buy the shares. Note, these basic selling strategies can often be done in a cash account, no margin required, but higher levels usually need margin enabled, which has its own approval and a typical 2,000 minimum. Okay, this is stating pretty much the same thing. They say there's tiers to 1 to 5. I'm telling you folks, 1 and level 2 is all you need. You don't need all that other stuff, and I don't recommend you go down that road. So level 1's easiest for beginners. Level 2, this is Fidelity, cash secured puts. Level 3, doing all this ridiculous advanced riskier strategies, which are risky, and they are talking to buyers. All this terminology happens to apply to buyers, okay? They're not talking to sellers here. They're talking to buyers because they know 90% in 90 days, lose 90% of your money, and then they're happy. You're done. 90% of your money's gone in 90 days. Then they have a sweep, and we were talking about that, or you can use different things in Fidelity. When I did this, you'll see asked the question up on December 19th, 2025, and it was saying that just a couple of days ago, they were paying 1.84% annual percentage rate for their sweep, but there are also other, like the SPAXs, which yield a higher 3.66. And that's something that you know about. Okay.
Can I just say
Yes.
one thing real quickly? If you haven't opened an account yet, and let's just say you're putting your IRA in there, speaking from the side of the brokerage firm, don't, it's gonna ask you what your comfort of investing is. If you're putting like ultra conservative or super conservative, that's not something, you might wanna do moderate or something like that. And it's also based on age, unfortunately, too, so there's a couple of things.
You did mention something that I may have an additional slide here. Now, the best account that you can do this in is called a Roth IRA, if you have it. Because you can trade and trade and trade up and down, lose, gain, blah, 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 and there's no short-term capital gains or losses. And you're not taxed. When you pull that money, you are not taxed on a Roth IRA, ever. Now, with the government changes, who knows? But right now, you are not.
Next,
Level down is a
traditional.
IRA. That's what I happen to have. But as I go, do what I'm doing in here, I know that I do not need to give any information to my accountant because it only applies when I take money out. And since I'm now retired, it's all on me to take out, and then that becomes reportable. Okay. The next level down
Is a brokerage account.
which does have tax implications. When you're trading, boom, 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 you're going to have short-term capital gains. Go bang, bang. Every time you buy to close, sell to open, that automatically triggers a short-term.